Let me give a couple quick introductions, and actually on my screen it works out. We have Guli, our long-running course advisor, here's in the middle of my screen. It just looks perfect to have everyone around Guli for this session. Rob up in the corner controlling things. We also say our chairman, Professor Don Wallace, has signed in, our director of programs, Gerhard. Thank you all for joining. And thank you everyone from logging in. It looks like we have several countries here. This should be a very good session. Thank you to Rob for pulling this all together from his beautiful tropical location. I think many of you know Rob, but let me just, he's an ILI course advisor. He's an executive advisor to businesses. He was at the World Bank for a number of years. He had a long career in the private sector with Conoco and then ConocoPhillips. A fantastic resource. I think you guys have been in his classes. Remember, energy he brings to his classes. For that reason, I think he's perfect to do the first of our ILI online sessions here. So thank you, Rob, for doing this, and the floor is yours.
All right, great. Thank you, everyone. The topics are obviously of concern to all of us, and it'd be very easy to get sidetracked as well. So I'm trying to keep this as narrowly focused as I can. Again, when we open it up for questions, maybe we can broaden the scope of our investigation a little bit more. So I'm going to try to warn you about that. And I think with that, I'd like to get started. So Gorgon, do you have the, yeah, perfect. All right, let's move a slide ahead. What's happening with commodity energy prices? How come they're so volatile, and why are they downward trending? What does the future potentially look like? And then I think very importantly, what are some of the possible maneuvers around policy and regulation and tactics that are available to countries facing energy supply uncertainty? So we'll try to talk all about that in the first 30 minutes or so. The disclaimer in the red is very important. I'm going to make some statements that might seem like they're coming from a medical expert. I am not that person. What I've done is tried to bring together as much and as best information I can about what's going on with the virus. And I've tried to use some statistical analysis as a basis of my remarks, but please do not go away thinking that medical Dr. Lesnick told you these things about the virus, okay? So again, I hope I can make that crystal clear. These are more a mathematical look at things, not a medical look. Okay, let's get going. So I think it's important to understand how COVID-19 is similar and different from what our normal experience is with health issues that typically come up in our lives. So the first common ailment is the common cold, okay? Those are episodic, they're not seasonal, and it's important to understand that coronaviruses are responsible for about 20% of the common colds that are out there. Rhinovirus is about 50%, and there's a bunch of others. In total, there are probably 40 or 50 different viruses that result in the same sort of symptoms. There's no vaccine for the common cold, and that's because, again, what I show here is there's actually 200 different virus strains. And so it's not that we couldn't create a vaccine for them, it's just that it's impractical. We'd actually have to get a cold shot twice a week, every week, all year long to prevent from getting the common cold. That would be very expensive, and it really wouldn't help very much because for most symptoms, they're minor. You get a runny nose or something and it's gone in a week. So you know, we always say there's no cure for the common cold. That's true, but there's a good reason why there's no cure for the common cold. The flu is different. The flu is caused by an influenza virus. It's preventable to a very large extent if you get the annual flu shot. Those shots, and one of the reasons you can do a flu shot is because there's typically only 1, 2, or 3 kind of variations, and you can put that all in the same shot. So there's a good chance that when you get a flu shot, you won't get the flu at all, or you'll get a very minor case because your body has already developed an immune system against the actual influenza virus that you would encounter. The annual experience with the flu is that a lot of people get it. There's still over 1 billion cases every year across the planet, and it results in 300,000 to 600,000 deaths. That's an awful lot, but it's still a pretty low incidence rate. And again, the point is, if everybody got inoculated against the flu, that number would go way, way down. And so we have kind of a defense against it. The current case with COVID-19 is that it's a very, very virulent form of a coronavirus, which you back up to the common cold and not with the flu. There's no vaccine or cures yet. What we're coming to find out is that it's very highly contagious, and the virus is passed through people who have no symptoms whatsoever. And so there are, because it's so contagious, there are a lot more people who have been exposed to it and have the virus than we actually know about. And those people are unwittingly passing it on to others who can come down with some very bad symptoms. What we do know is that the people who get sick have much longer recovery times, and there's a much higher mortality rate than with the common influenza. Where we are today is somewhere between 2 and 20 million cases. And again, that range is gigantic. And part of the reason is we just don't know how many asymptomatic people are running around the planet right now. And by the end of today, we'll probably have about 200,000 deaths. And so we're just getting started, and we're already at the low end of the annual flu rate, which is what is really causing concern among social planners and policymakers. My comment here, I think, is something that we should all keep in mind. In retrospect, we've compared COVID with the flu, understand why that might have happened because of some of the similarities in the experiences, but it's actually probably not helpful that that was done and that we continue to think about it that way, because it's really not the flu, and we really don't have a defense against it like we do the flu. Okay. Next slide, please. So here's what I'd like to do is for everybody who to take this test with me, okay? So here's the riddle. 10 people who have the COVID virus but don't know they have it, they're asymptomatic, go to a football match, okay? And they do the things that you would normally do inside of a football stadium. They go to the bathroom, they get something to eat. When their team scores, they cheer loudly. They take maybe some public transportation to and from the stadium. They come in contact with people and unwittingly pass the COVID virus onto them. And those people unwittingly pass the COVID virus on to others. And it happens one more time in 21 days, that those people pass it on. So the question is, if 10 people enter the stadium with the virus, how many people will have the virus after 21 days? I'm going to give you all 10 seconds, and I want you to write a number or think of a number in your head. Jeff, you got a number?
Yeah, I was muted. I'll say 1,000.
All right, so here's the deal. For anybody who said 10, well, let me just say this. You're all probably wrong, and you're also probably right, right? There is just so much that we don't know about this disease that it's really impossible to get a good idea. But if you said 10,000 or less, you're probably low. If you said 1 million or more, you're probably high. In the simulation I ran, it was 185,000 people would have the virus in 21 days. It's that contagious, okay? And it's so easily passed on. With 185,000 cases, about 10 to 25,000 would actually show symptoms. about 2,000 to 3,000 would need hospitalization, and about 200 to 300 would die. So if 10 people who didn't know they had the disease went to the stadium, 3 weeks later, 200 to 300 people would be dead because of what they did, which was just go cheer on a football team. I'm going to let that kind of sink in for just a second as we go to the next slide. So where do we stand right now? Okay, the trajectory has been pretty dramatic and pretty devastating. So on the left side there, the blue line, you see how the number of cases have grown worldwide. That's on a logarithmic scale. So even though it looks like the number's kind of folding over, the number of active cases are still going up fairly dramatically. What we think is that with social distancing, the number of active cases may actually turn over. Okay, and so the epicenter of the disease right now is in the United States primarily and Europe secondarily, and that's what's driving that blue line rising. But we're thinking we're getting close to the apex and that number may turn over. What we don't know, and because there hasn't been good testing and really good reliable data, is what's happening in South America, in Africa, and in South Asia, where the potential for it to multiply is really, really high. So it's possible we haven't heard from those regions of the world yet. And so while that orange line is showing a decrease, this red line is really potential, and there could be a second eruption of the disease in different parts of the world to drive the number of active cases back up. So again, to summarize, the current trajectory is US and Europe. The intermediate term is going to be determined by India, Brazil, and the African countries. The longer term, again, we still don't understand the disease. We don't know if this is a one and done or it might recur like the common flu. Obviously, we all have a preference about how it's going to go, but we just don't have the medical facts yet to really know the answer. Next slide, please. So, what does this mean for policymakers and social planners? Okay, well, so far the world has reacted based on the worst case pandemic estimate, which is that billions of people will get ill, and death rates might exceed as much as 10 times the amount of the influenza experience. Okay, so that means millions and millions of people could die of this. And to try to prevent that, we're taking some very extreme measures. Unfortunately, over the last 2 months, we really haven't gained a lot of knowledge about how this disease is spreading. The US has become the largest area that's infected with the most severe illnesses and deaths, but our reporting has been just unimaginably poor. There's no real standardization of testing or reporting. The federal government has pretty much left it to each individual state to do this as they want. That has led to really inconsistent reporting. Less than 20% of the administered tests are positive. The bottom, there's 50 states in the United States, just to remind you of that. The bottom 40 states, so the states that have tested the less, have tested on average 30,000 people per state, which is virtually, the size of a teeny town in one of these states. So there just isn't a lot of information still, even though this disease has raged now for well over 6 weeks. There's some new evidence that's coming that's really setting the traditional wisdom on its heels. There was a study from Santa Clara, California that suggests that the infection rate may be as much as 85 times the number of positive tests that have been reported. So for every positive in every test that says this person has the virus, there's potentially 85 others who also have the virus but haven't been recorded anywhere. If you look at the mortality rates, just the global mortality rates, and then look at the US number of mortalities, the number of deaths, then we should have at least 8 times the number of people with the disease that's been reported. So again, we're really just don't have a lot of data. When I talk to people about this, what I say is we're trying to develop policy and actions as if we were driving a car, looking through the rearview mirror in the middle of a fog. We're looking at old data and we're in an environment where it's just not clear where the heck we are. Makes it very, very difficult, again, for policymakers to decide what to do. The only defense we have right now is avoidance. So there's no vaccine, there's no treatment. Last couple of days, the chloroquine malaria treatment is proven to be a dead end, not been judged not to be effective at all. So there's no treatment and there's no vaccine. So the only thing we can really do is kind of stay away from one another until this dies down, which is what's led to the global lockdown and has led to this huge collapse of the global economy. Okay. So what's happened? The numbers, again, are just starting to come out. The reaction is very clear. 2 days ago, the price of crude oil in the United States actually dropped below zero, which obviously is a first that we really wouldn't like. Huge volatility in the markets. What we seem to know is that demand for energy products is down, and the numbers are different depending on what agency is reporting, but it appears like the second half of April, energy demand, primary energy demand is down about 30% for that period of time, which is absolutely unprecedented. I saw a report yesterday out of London that said that the need for petrol for taxi cabs is down 40% in the city of London. So what measurements have been taken and reported seem to indicate that the amount of demand for energy has just plummeted in the last 6 weeks. So that's driven crude oil down. The next slide. Similarly, this is the landed price for liquefied natural gas. You can see that over the last 3 months, the price there has dropped precipitously. Not only is the absolute price under $2 a million BTU for most places, the prices, the regional prices, excuse me, have contracted so that there's really very little difference in the price of the commodity from one area to another. Most of those lines, we're talking about LNG here, so it takes money to get the gas to the LNG plant. It takes money, takes costs to turn the gas into LNG, to ship it, to regasify it, and to get it to market. Most of those numbers are actually below the cost of operation. So the commodity piece of those April 20 numbers is right at about zero. The cost of the commodity value of the gas itself is right about zero. And what you're seeing is the cost to do everything else. And the difference between the yellow line and the blue line is basically the added cost of transportation to get LNG from the Gulf Coast to the Asia Pacific market. And that's the only really difference in the cost of the product at this point. Okay. So let's talk about why that's happening. So I want to take just a couple of minutes to review basic pricing and economic theory. And the way this is traditionally talked, and the way I've always discussed it, and I didn't realize it until this situation came up, is there's always an underlying assumption that economies are rising, that economies are growing. And with that presumption, what generally happens is that you're in a seller's market where there are more, because the economy is growing, there are more people who want what you are producing than there is production to meet that demand. So in that case, you're in a seller's market and the price sets the quantity. And let me just kind of try to show you this very quickly. So we're going to start with the red line, which is the production line. And what generally happens is you produce the cheapest product first, especially if you're in a commodity. So if you're producing rice, or in this case, crude oil, the first production is going to be the cheapest to produce. So the price, the red line, starts along the price line at a very low point. And then because there is demand for your product, people are willing to pay you to produce more. And so you continue to produce more at higher and higher prices. So in the case of crude oil, you produce oil from deeper horizons, you produce oil that's further offshore, you produce oil that's in tight sands or shale. It's more and more costly to produce, but as long as a buyer is out there willing to pay that price, then you continue to produce at a higher and higher cost. So that's why that line, that red line, goes from the bottom left to the top right. As more and more price is offered, the amount of production that can go up. On the other hand, consumption works the other way. So as costs go down, more people are willing to purchase the commodity. And where those two lines are cross is where the equilibrium point is, and that's generally what sets the price of a commodity. So if oil is selling for $30, all that oil that could be produced for below that enjoys that margin. Even if it costs them $1 to produce it, they're going to sell it for 30 because they sell at the equilibrium price. If it costs oil $40 to produce, it doesn't get produced. So it's on the right-hand side of that equilibrium point, right? So the price ends up determining what the quantity is. Price sets the quantity. All right, let's move on to the next case. When you're in a falling economy, everything turns on its head. And again, I never really thought about this until we got into this situation. When you in a falling economy, it turns in not to a seller's market, but a buyer's market, where the quantity ends up selling the price or setting the price. So what happens is, in this particular case, nobody is in a position, that people are in a position to consume a lot less energy. People aren't driving, they're not using products and services that require a lot of energy. And so the demand for, in this case, crude oil or petroleum products goes down. So what happens is the consumption line, the blue line, is what's setting everything. And that is going from the bottom right to the top left. So as the consumption goes down, the quantity again goes to the left, and that point is again setting the price for the crude oil. So in this particular case, as consumption slides to the left, production has to follow suit. So higher cost production again is that might have been running, is shut down first, and production levels continue to get shut down until the production matches the consumption. And whatever that cost of production is what's going to set the price. So in the case of a buyer's market, it's the quantity that determines the price rather than price determining the quantity. So it's absolutely backwards. I know that this is theoretical. We may have some questions about this later. Happy to kind of talk about it more, but for now, let's just move on. And I just wanted to kind of show you how the dynamics of this situation are working. So to the left, we have this balance, a supply-demand balance. And in a perfect world, in a Keynesian economic theory model, supply matches demand, and you have an equilibrium price. It's going to be set either by the incremental supply or the incremental demand, but you have an equilibrium price. So let's just, for a second, don't think about the right-hand side of this so much. Just think about that scale. So let's just put a cup of rice on both sides. One cup representing supply and the other representing demand. And they have about 10,000 grains of rice in each cup. It's a small grain, but kind of an average amount of grains of rice per cup. Okay, 10,000 each, and everything's in balance. So if I was to add a grain of rice, just one single grain of rice to the supply side, what would happen? Well, the supply side of the balance would go down. The demand side would go up a little bit by whatever that one grain of rice changes, and that needle would move over to the left, just a little bit. So the price would go down because the system's out of balance, okay? And it's that, what I want you to think about is it's the marginal price, it's the marginal amount of supply and demand that is driving the price. If we put one grain of rice on the supply side, that needle will tilt. But think about the total balance. You've got 10,001 grains on one side, 10,000 grains on the other. The system is basically in balance. It's 99.99% in balance. But nevertheless, the scale is going to move. Okay? It's the marginal supply or demand that's going to change that. If we took the supply grain off and put it on the demand side, then the system would be out of balance again. And the scale would move to the right, the needle would move to the right, and the price of rice would go up. Now, it wouldn't go up much because we're in pretty much one grain of rice isn't going to set the commodity balance, okay? But it is, again, it's the marginal supplier demand that's important here, not the average or the total balance of the commodity. So what happens, again, when you're buying rice is the very last transaction, the marginal willing buyer and willing seller decides what the price is going to be. And if it's easy to get that one extra grain of rice, then the effect won't be very much. If it turns out that that's a very important grain, then it could have a big change in the price, even though the total commodity is in balance. So what happened with crude oil? Well, it didn't just move the needle, it knocked the entire balance right off of its foundation, okay? So the current demand for crude oil is, again, according to the IEA, down about 30%. And I'll show you some numbers in just a minute to show you how big a change that really is. We're not talking about one grain. We're talking about 3,000 grains of rice being taken off of the demand side. Okay? At the same time, Saudi Arabia and Russia decided to have a fight about reducing production. And so Saudi Arabia and Russia both actually added more supply to a system that was already out of balance. And that was the equivalent of about 750 more grains. So instead of a system that normally is 99% in balance, within a week, we went from basically being in balance to being 75% in balance or 25% out of balance. Okay? And you can imagine, well, you can see for yourself 2 slides back what that did to the price, right? So we took that demand number, the blue demand, and took out 3,000 grains, and we added 750 on the red side. That needle just smacked at the very left-hand side. In fact, it went so far off that it, for a while, the price of oil went actually negative in the United States. Okay, let's move on. So what does that mean for countries? Okay, and the answer is, well, it means different things for different countries. And it depends on what their situation is. And so one of the things I want to challenge people who are listening to this is, think about this in terms of a couple of dimensions. And again, every country has a kind of a separate situation. The two that I've plotted here are supply balance as a country. Are you pretty much in balance? Are you an importer or are you an exporter? This happens to be crude oil, but you can think about this in terms of, energy in general too, if you would like. On the other axis is, how important is oil to your gross domestic product? Okay, if you're a consumer, like the bottom 2 countries on the left there, Japan and China, that still represents, even though maybe the industry isn't a big part of your economy, the cost of the commodity may be also a part of your economy. What I've tried to do here is just say, to what degree does the industry actually affect your economy? So you have 4 different quadrants there. On the top right are countries that are highly dependent on the sale of crude oil to meet their annual budgets, and they are large exporters. And if it isn't crude oil, it's something like it, like condensate. So, or even natural gas. So in the top right, you see Qatar, Saudi Arabia, Iraq, Iran, Venezuela, Nigeria, and Russia. In the middle, they're fairly balanced, is Brazil, the United States, and Canada. And in the bottom left are countries that are energy consumers, crude oil consumers, and I talked about them already, Japan and Russia. So the effect of changing crude oil price really is going to affect these countries in very different ways. Next slide. Same thing is true with natural gas. I'm not going to go through each one of these, but you can see here that countries fall into all 4 quadrants here. The quadrants are, you have a lot of gas, you use a little, so you tend to be an exporter. You have a lot, you use a lot, you have a little, you use a lot, and you have a little and you use little. And depending on where you fall in that, the change of the commodity price is going to make a big difference. And your response is going to be different based on that. Okay? So what do I see? Okay? What I see is at least 12 to 18 months of low hydrocarbon prices, which include both crude oil, or all crude oil products and natural gas. An extreme shortage of storage facilities. So we're going to see products, and it's already starting to happen, products stored on the water in tankers that normally are supposed to be transporting are going to end up just storing both crude oil and products. And we're going to see prices, again, traded prices go negative. There's going to be a lot of energy company failures. There's going to be personnel cutbacks, project cutbacks, project delays, and project cancellations. So we're going to really see a dramatic halting of the energy day-to-day business as we know it. I think a lot of climate change strategies are going to be hurt by this because people are focusing on other things. The fact that energy commodity prices are going to go very low is going to make it very difficult for alternative energy to compete. The winners, if there are winners, are resource poor countries, those countries that need to import the resource. And the losers are going to be the resource-rich countries, those that are exporters and have counted on oil and gas revenues to support their annual budgets. I put both of those in italics because there really aren't any winners here. And if the energy industry really goes south, and many companies are bankrupt and many countries go bankrupt, it's going to affect everybody in the long term. And there may be some short-term gains by big importing countries, but longer term, nobody's going to win by that. The picture I put up there is kind of interesting. It's a picture of the Himalayas from a northern Indian state. The first time they've seen the Himalayas in 35 years. So one of the winners here is the Earth. Planet Earth is actually, a lot of the, some of the environmental hardships have actually been reversed because of this. Okay, let's move on. We got just a couple more slides, I think, and then we can stop. So what's going to happen after this is over? Well, I don't know when it's going to happen, but we have 3 different recovery possibilities, and I just kind of wanted to have you think about that. But before we get there, I just put that down arrow that shows the current reduction in demand for primary energy. I'm not saying that for the entire year, planet will be down 30%, but what if it was? Okay, have a look at the magnitude of that arrow compared to what we saw in 2008 and 2009. That was about a 3% drop in demand, and it really shook up the global economy for a little over a year. But you can see how that it was short-lived. We had a little bit, it was a V recovery, basically, that demand went down for a little over a year, and it went right back to where it would have been as if it had never happened at all. You could just, that line could have been drawn straight over the top. If you do something like 30%, for one thing, the magnitude is just stunningly unbelievable. It would take us back to about the year 2002 or something, I think. Really dramatic. The possibilities, again, that economists talk about are 3 different kind of recoveries. One is a V shape, which is kind of what we had in 2008 and 9, where you go right back on the same trajectory, you just had a blip for a period of time. The other is U-shaped, where you go back to the same trajectory, but it takes longer. And so there's a longer period of reduction and then a slower period of recovery. Where the first may happen in 12 to 18 months, the second may occur in 2 to 3 years. The final kind of recovery is L-shaped, where you actually reset the norm and you never ever get back on the trajectory that you were on prior to the upset. There is a case that we could be on an L-shaped recovery. There is a case that we could be on a U-shaped recovery. If you think about just automobiles, for instance, for petroleum demand, we haven't destroyed automobiles in this crisis. People still own them. Industries still own vehicles. The trucks are still out there. It's just that we're not driving them as much as we were in the past. So when the recovery comes, are those trucks going to just go right back to the trajectory they're on, or have we learned something different about how we use vehicles in the world? If we have, then you get that L-shaped recovery instead of the U. And the answer is we just don't know. We're just going to have to see. But it's probably, in my personal opinion, it's probably some kind of modified U, that you're not going to go right back to the trajectory. It's probably going to be lower, but it's probably not going to be a pure L either. And we'll just have to see. But as time goes on and we learn how to adapt in this new world of living that we're in, there's a good chance that the demand for energy will be adjusted lower, at a lower rate anyway, for the time to come. And I think that's probably one of the good things that can happen out of this. We'll become more energy efficient and more energy conservative. And I think that's probably in the long run good for us. So what can governments do? This is my last slide, and then we'll take questions after that. This is an excellent time for policymakers to think about transitioning from arbitrary price controls to market-based controls. So if you live in a country where 4 people get in a room and decide what the price of motor gasoline should be, or natural gas should be, or the price of electricity should be, and it's pretty much arbitrary, this is a good time to think about switching over to a market-based approach, because the price of those commodities are going to be very low for the next several months, maybe the next couple of years. And so you can get civil society to come to recognize that it's not government control, it's the market forces that are at play that determine these prices. When prices do return to kind of a more normal global average, then you can introduce policy and practices to pass those costs on to consumers rather than have to subsidize those prices and use precious financial resources that most governments don't have to subsidize the price of energy. So if you are ever thinking about going away from an arbitrary government-controlled system to a market-based approach, now would be a great time to do that. Similarly, it's an excellent time to review current subsidies that are in place, including power supply. This is a time where you can take those subsidies off and let the real price of things pass through the system, because the real price of things aren't as high as they were. For countries that use a lot of biomass, and for those of you who know me, I really have issues with the use of scavenged biomass throughout the world. I think it's an unsafe, unenvironmentally very dangerous practice that's not very productive. And so here's an opportunity to try to get people to stop using biomass and substitute conventional fuels of some sort. Whether that's natural gas, if you could somehow reticulate it into some of these areas, or kerosene, or whatever it might be, LPG, to take the place of scavenged biomass. This would be a great time to start executing some of those programs and projects, because the cost of those commodities are going to be very, very low. And so the net cost of conversion is going to be a lot lower over the next 18 months than it might have been otherwise. If you're a consumer, I would be very cautious about your market-based energy contracts. Look at what they have to say. There's going to be a lot of people looking at the legal documents and seeing what the contraction of demand and what the lowering of price might say inside those contracts. And there's going to be buyers and sellers both looking for relief. So if you're in that area, or you know somebody that's in that area, have them dust off those contracts and take a very close look at what it says around some of these market condition changes. If you are using a lot of short-term contracts, this would be a good time to convert from short-term to long-term, because you can determine prices now at lower costs that you might be able to apply longer term. Producers, you know, you've got a tough time. So if there is plans to invest in oil and gas projects, this would probably be a good time to try to take advantage of some low-cost products and services, if again you can find any. But for instance, drilling rigs are going to be pretty cheap. So if you can contract some of those now, you would be able to leverage that in the future. If you have plans to economically diversify your economy, this would be a good time to really start executing some of those diversification options, because dependence on the oil sector, the petroleum sector is probably not going to pay much reward over the next two years, maybe, or even more. And the last thing I would do is, if I was a producing country, is really consider banking your reserves. Instead of producing crude oil, reduce that and save those reserves for some time later. Let the global glut of crude oil work itself off, even if it means stop producing your oil and using somebody else's oil for a time being, and then selling yours at a later time when prices are high. So those are some pretty high level strategic things to think about, but need to be thought about, because the next, like I said, the next 24 months at least, going to be a challenge for the industry and for countries that that are either depending on oil for their revenue, or having to traditionally pay a lot of money for their energy. I'll stop there and let's take some questions.
Well, let me jump on. We did have one question during the presentation, Rob, and that was, well, you were discussing the winners and losers, although noted there might not be any real winners in this. And the question was, is it correct to say the greatest losers are exporters? But let me also then ask in there how maybe countries that are new to exporting or newer to exporting, and maybe even countries that are still in the exploration phase, fit into that process as well.
Yeah, I mean, clearly, countries that depend on the sale of petroleum and petroleum products are in the near term really facing crises. So countries like Iran, Iraq, Venezuela are going to have unimaginable problems. I mean, they're just literally not going to have any of the revenue that they were anticipating, and how they're going to pay for the cost of operations is going to be really challenging to them. Saudi Arabia is a little bit different. Saudi has a lot of production that is cheap to produce, and they also have a fairly large stockpile of funds that they've created over the years from excess revenues that they can tap for a while. But the Saudis have got themselves into a big problem long-term as well, because their expenditures have been pretty much uncontrolled as a government. And so they are, even though they, you know, again, they've got some cash reserves, they're going to have to really shut down their spending if they're going to try to weather this storm. And if Saudi goes under, you know, the entire crude oil supply, global supply, is cast in doubt at that point. It becomes really, really significant. If you're a country that is planning to export, you know, it's probably just unfortunate, just the worst time you could possibly try to enter the market, and it just doesn't make sense to exacerbate the problem by bringing on new production at this time. So the best thing for the global petroleum industry is to delay, and that will probably happen. The projects will get delayed, you know, new projects will probably try to operate at the minimum they possibly can to cash flow, to pay their expenses, to pay off their debt, but otherwise probably try to take a very conservative approach.
I've seen no other written questions. I mean, feel free to type a question or at this point, if you want to just unmute and ask questions that way. Are there any questions out in the audience?
I know one of the questions that I've got is, well, two things. First is, how the heck could the price of oil go negative? Why would anybody give somebody else money to take their crude away? Okay? And the answer to that is, well, that actually didn't happen. Okay, when you see, and I don't know if you have seen, but again, I showed you the picture. For a couple of days, the price of crude oil actually went negative on the NYMEX exchange. That is not a physical exchange place, it's a financial institution. Every day, about 100 times the amount of crude oil is traded electronically from traders that are commodity traders. So they're not actually buying crude oil buying crude oil because they need crude oil. They're buying crude oil because they think that the price of crude oil is going to change sometime in the future. So what happened on the NYMEX is a lot of well, you need to have a willing buyer and a willing seller. So what happened is early in the month, late last month, early this month, people saw the price of crude oil on the NYMEX at about $20, $25. And half the people that participated said, that's a good price. I'll buy that crude oil at that price because I think the price is going to go up by the end of the month. And there was an equal number of sellers who said, you know what, I think that's probably a pretty good price to sell at. The price may go down. So a trade was initiated. The buyer didn't ever intend to take the commodity, to the actual possession of the crude, and the seller didn't have it to begin with. And so both planned at some point in time to reverse that position. And so what happened was, as we got closer and closer to the trading date, these were April barrels. When we got down to the trading date where you had to close your contract or take possession, the people who were holding these $25 barrels started to panic and said, we need to sell out of our position. Sensing that, the buyers just stood on the sidelines. Imagine if you went to a department store and they had a great big sign that said, next week shoe sale. Okay. How many pairs of shoes do you think they would sell that day if they advertised that a week from now they were going to have a giant shoe sale, right? So nobody would do it. Well, that's kind of what happened in the markets. People decided, no, there's going to be a sale next week. We're not going to reverse our contracts this week. We'll wait till next. And so people literally got stuck and they had to sell their contracts to get out from under this obligation to take possession. And they eventually said, look, we'll even pay you just to get us out from under this contract. So that's why the price went negative. People out in the field were not actually giving people money to take their crude away. Okay? The other thing that I get asked is, well, why haven't people just shut in production? Why hasn't it stopped? There's a very complex answer to all of that, and we could probably take a whole half day to talk about why that's the case. But let me just give you two reasons, really high-level reasons, really quickly, because I think this is important. The first is that when you're in a hole, the first thing you should do is stop digging. Okay, if you find yourself in a hole, the first thing you should do is stop digging. And that's what most industries are doing right now. People are, the institutions, whether it was a state-owned oil company or a private sector company, were spending money to continually produce more and more crude oil. The first thing you're going to do is stop doing those things. So they stop further drilling, they stop completions, they stop planning to do more things that were only going to exacerbate the situation. So that's where you start. And then once you're there, you start to look at, well, now what do I do? I've stopped this process of making more. Now I got to start shutting in what I've got. So I hope that makes sense to everybody. The reaction is, again, let's stop what we can financially and future-wise, and then we'll look at what we're doing on a day-to-day operation. You wouldn't just, well, there's a couple of reasons why that's going to take time. If you shut in a well, if you flat shut in a well, there's a chance it'll never produce again. Okay? Physically, that can happen. And so it's very risky to just shut in a well. So you wouldn't do that. The other thing is you want to shut in your highest cost production first. and leave your cheapest oil running. That kind of makes sense, doesn't it? You're losing a lot of money on the high cost stuff. Let's shut it in first. So that information isn't readily available and readily transparent, especially if you think about who's making some of these decisions. Right? If it's a state-owned oil company or if it's a ministry, they don't really know what field or what oil well is the highest cost. They don't know what field or oil well could suffer if you started to shut things in. So it's going to take a lot of time because you just don't think about these things. You're just producing 100% as much as you can for years and years and years now. There's very little information that's flowing backward about the state of your system. So it's going to take time for people who are in the decision-making process to find out what can they do and where should they be directing their efforts. So it's going to take quite a while for that machine to stop the forward spending and to get the information and start looking into their operation areas and decide where to cut back.
There's a question submitted by Aliu. How long do you think it will take for price to come to proper equilibrium after COVID-19, especially that new regulation for flights, etc., will be worked out, given the limited strategic storage and negative prices due to storage in vessels and the excess production capacity worldwide? Is there any possibility that prices will ever go beyond $15 and in the medium term after COVID-19? And also, what is the effect of shutting the wells as there are no storages and buyers, Nigeria, a case in point? Yeah.
So, excellent questions all. The typical view of the price of oil is somewhere around $50. But that's kind of an equilibrium point, and it can swing anywhere from the mid-30s to the $65 kind of dollar range, depending on again whether the grain of rice is on one side of the scale or the other. It could return to that kind of equilibrium price, but there's going to have to be discipline in the market, and we're going to have to see whether we have a U or an L-shaped recovery on demand. It's just really going to depend on how the market reacts. That theoretical chart that I showed you with the red line and the blue lines crossing, that assumes that there's discipline in the marketplace and that there's a lot of transparency in knowledge. There's a lot of feedback that can be processed and reacted to. Part of the problem with trying to balance this is we don't just have one player. If there was the god of oil and that god knew everything, knew which fields were the most expensive and could push a button and dial back production, then this thing could probably be balanced fairly quickly. But that isn't the case. You've got, you probably have 30 major players in terms of countries, and literally thousands of companies and institutions that are involved in this, and hundreds of thousands of wells. And so even if you had perfect knowledge, you have different ownerships, different motivations, different obligations. When you have that many institutions and that many decision makers involved, they're all going to start to point to each other. You want me to shut I thought you were going to shut the well in, right? So trying to get that kind of discipline and cooperation is really, really hard to next to impossible, because those decision makers have different priorities, different obligations, and they're mutually exclusive in many cases. They're not all pushing on the same rope. They all have their own little ropes that they're pushing on. And so to try to find a way that happens is going to be very, very difficult. I think the market in the end is going to make that decision, that companies are going to get out of the business because they simply cannot supply a market at the prices that the market will bear, and that means that production kind of leaves forever. And so there's a really good chance that sometime in the future it's going to swing the other way, that we're going to have a shortage of supply because so much of the production was destroyed. One other thing I'll say, and I know it's a long-winded answer, was around the storage. That's another piece of the puzzle that I don't think we've fully come to understand yet. Even when production gets more imbalanced, there is probably going to be at least a half a year of surplus storage that needs to be worked off. And will people have the patience to let that happen is also an unknown. So, you know, what comes around goes around. You know, sooner or later, this will all change back to kind of a normalcy, but it's really, really difficult to predict right now. And in the near term, I would say, you know, the plan should be for kind of a sub-global equilibrium price. You would expect it to be well under $50 for quite a while.
We have another question from Nada. Is it possible that companies start hoarding and thereby prices may start rising again? Is there a law against hoarding?
You know, I guess what you're talking about is hoarding crude oil supply. You know, the quick answer to that is no. There is really a finite amount of storage, and the total amount of storage, the total amount of spare capacity that exists today is so small relative to the production overhang, the production oversupply that exists today, that putting barrels in storage actually is a good idea, but it's not going to, you know, it's not going to affect the that marginal supply-demand balance to a great enough extent that it's going to change the price very much.
Well, if you've got another minute or so, Rob, I'll pose a question if there's none out there. I saw this morning that Total was purchasing Tullo's joint, I mean, they have their joint project. Tullow was selling out $575 million to Total. Is this maybe indicative of a trend? Will some of the majors and super majors come out kind of as winners through this, or will some of the, no, there's not smaller companies, but smaller than the super majors be losers in this process?
Yeah, I was talking to a friend who's with Chevron a couple of days ago. They're clearly looking at a way, highly capitalized companies are certainly looking at ways to acquire interests or completely buy out companies in this. I think it's too early to say exactly the degree to which this will happen. My personal opinion is that there will be properties that companies will just be able to take over. They won't have to pay a cent for it. They'll just have to assume the liabilities of operation. It'll get that bad. But you know, if oil prices really do stay in the single digits or low teens, it's going to be hard for any company to amass a lot of money to continue operations, let alone acquire other things. So it's, you know, but I think certainly we're going to see a lot of that. Those that are more well endowed will have the ability to take advantage of a lot of the financial upsets that are going to occur in the industry.
We have another question from Alio. I hear that because of the contracts involved and the lack of storage, production is done directly into vessels. The negative prices may continue more so that the factories and parked vehicles are yet to kickstart. What point will the production from these wells last before they are shut down?
You know, the reality is it's on a case-by-case basis. There are literally hundreds of thousands of producing properties across the world, and each one of those have their own story. In certain, you know, I'm pretty familiar with what's happening in the United States, and in many places, you have small producing facilities that are being pumped into field storage locations, and it's 500 barrels of storage. I mean, it's virtually nothing. And then that facility opens up the tap and it goes into a pipeline that gets eventually pushed down to refineries in the Gulf Coast. That situation for those particular properties is going to be limited to the 500 barrels that they have on their property. If somebody doesn't come and drain that tank, they have to shut in their production. There's literally nothing else they can do. Obviously, in other offshore locations internationally, the situation is much different. A lot of places they're loading onto vessels right off the platform. It depends on whether they can find a crude oil storage vessel that's empty and that's you know, charterable, and it can come by and pick up the load. So I guess the answer is, you know, certainly these things are going to occur. We're going to have operational bottlenecks that are going to dictate what happens, but it's going to be almost on a case-by-case basis. It's very, very difficult to generalize. So in some cases, operations will go on pretty much as they always have, and in many others, they're going to be truncated or bottlenecked because the logistics of getting oil and gas out are going to be are going to be compromised.
Good. It seems like we don't have any more written questions.
Well, I think we've kind of come to the end of our time contract. So let me just end with one more thought, okay? And that's that there's still this whole episode, or you know, this whole problem has occurred because of this global pandemic, that there is so much that we still don't know. So that's kind of why we scheduled the talk the way we did. Until we get more information, it's really going to be tough to understand how that really translates into the energy sector. And I think we're starting to see some new data emerge that's going to challenge the way we think about the pandemic to start with. And so I want everybody to kind of watch this space. The conventional wisdom is that it was kind of a bell curve where a lot of people on the left-hand side of the bell curve didn't get very significant symptoms, and the people on the right-hand side of the bell curve died, and a lot of people in the middle got sick. I think what we're finding out now is, and I'm not a medical person, but what the numbers seem to appear to me is that it's not a bell curve at all. That there's far more people on the left-hand side of the curve that don't have any symptoms whatsoever. And then it just asymptotically goes down from there. And people that have some sort of existing condition are the ones that are most susceptible. And it's a very, very violent end that comes to these people. If that's true, and we can figure out a way to protect those who are most vulnerable, then we can pretty much send everybody else back to work. And that's a very different approach, which nobody is taking at this point. There are some communities that are saying, you know, we just want to get back to work, but they're not really thinking about the people on the right-hand side, and that's an inhuman or inhumane and really not medically supported activity. So I think we just need to watch the space, as we need to find out again what's going to happen in Africa and in South America and South Asia. If the virus takes off there like it has in Europe and in the US, you know, boy, it's going to be really, really hard for a long, long time. So we got to hope for the best there. So again, this is, you know, this is trying to explain kind of what's happened and where we are. It's really not trying to explain what's happening in the future, because we really are looking through a rearview mirror in a fog, trying to figure out what the future looks like at this point. So be vigilant, be smart, think, you know, as information comes up, maybe think about what we talked about here and how that may play out into a recovery. That would be kind of my final words.
All right, well, thank you, Rob. Thank you everyone for joining. I know a few people joined in the middle, more towards the end. We did record this. We hope to get this online, so an opportunity to see some of the parts you missed there. And I guess we've got people all across the world, so I'll say good evening, good afternoon, have a good day. Thank you.
Thanks again, everyone. Stay safe.
Thank you for having us. Thank you so much.
Thank you.